Vesuvius India is a global leader in metal flow engineering, principally serving the steel and foundry industries. As on June 2021, promoter owns 55.6% and the company has 4 manufacturing plants. Higher production of steel supporting volumes for refactories, strong support from the MNC parent in terms of technology and marquee clientele, increasing share of high-margin service business and strong balance sheet are the key draws for the stock. According to various industry reports, steel production is likely to increase by 9 to 11% in FY22. From 2022 to 2025, India is likely to witness incremental capacity of more than 18 to 20 million metric tons. Steel plants in India consume 8 to 10 kilograms of refractory per ton of steel on an average, although the figure can be as high as 14 to 15 kilograms, depending upon the quality and the age of the steel plant. Refractories are consumables for the manufacturing of steel which requires replacement every half hour to 3 hours. Parent Vesuvius is global leader in refractory manufacturing with manufacturing locations across the globe. Its global market share in refractories currently stand at around 10 to 12%. VIL has access to the latest technology from the parent which help in getting the best manufacturing practices. Vesuvius charges royalty, trademark and license fee to the tune of 1.5% of revenues. VIL has developed strong customer relationships. JSW Steel, Tata Steel and Jindal Steel and Power are some of the names which VIL deal with regularly. These players accounts for nearly 40 to 45% of the steel manufacturing in India. VIL has increased its service revenues from 4% to total revenues in 2013 to nearly 26% of the revenues in 2020. Services business has grown at a CAGR of 35% from 2013 to 2020. With lower share of trading revenues and increasing share of services revenues, VIL's margins are likely to remain higher and much stable. Gross margins in trading business would be around 15%, while in services business, it is likely to have much higher gross margins of around 45 to 50%. As on June 2021, VIL has cash balance of 533 crore rupees compared 560 crore rupees at the end of March quarter. Its cash and cash equivalent is nearly 22% of market capitalization. VIL has consistently reduced its working capital requirement, which was almost 125 days in 2016 to 50 days in 2020. Return on capital employed has been in the range of 22 to 24% with exception of CY 2020, where it dropped down to 9% as sales and profitability were impacted for the March to June quarter due to COVID-19. Risks. VIL is charged around 1.5% as royalty based on revenues from the parent. Any increase in royalty rate can impact operating margins. The key material used in manufacturing refractories are bauxite, alumina, silicon carbide, and graphite. Some of these raw materials have witnessed very steep prices increases, especially alumina and graphite. Inability to pass on the higher prices will impact margins in the near term. VIL is a proxy play for the increased production of steel, which is likely to be seen in FY22 and FY23. As per World Steel Association and various other industry associations, global steel demand excluding China is likely to witness a 7% growth from 2020 to 2022. Crude steel production in India is on course to achieve 10 to 11% growth in FY22 compared to FY21. With India now being the second largest consumer after China, demand is likely to grow by 15% from 2020 to 2022. VIL's presence in India will turn out to be a distinct advantage. We expect revenue growth of 10% for CY22 and 8% for CY23, with margins increasing on the back of increased manufacturing and service revenues and operating leverage. VIL is currently trading at profit to earnings multiple of 20 times CY23 earnings. Investors with a longer term view can accumulate at current levels and add on declines.